We always knew that the first half of the year would all be about the inflationary pressures on our input costs, particularly in Europe, which is an important region to us. We front-loaded the year with pricing. As such, we expected some volume softness in the beginning of the year. Overall, we are quite happy with our strong revenue growth. We grew revenue between 9 and 10% in 3 out of 4 regions. A very strong revenue growth in Europe, in the Americas and the Africa region, but indeed with softness in Vietnam. Underlying, what's very important to us, that we see very limited downtrading. Actually, our premium brand portfolio outside of Russia and Vietnam actually growing in absolute terms. Brand Heineken up 3.7%, almost 10% better than the overall volume trend. So we feel that we have been navigating the first half of the year pretty well. But indeed, the situation in Asia and particularly Vietnam is somewhat different.
And could you elaborate a bit more on how things are faring on that front in terms of easing supply chain challenges and the bottlenecks, and also managing inventories in Vietnam? Because obviously you built up a lot for the Lunar New Year celebrations. Has that kind of eased off?
Yes. Yeah, I think it's globally, we do see the supply chain situation normalizing. Last year, there was a lot of scarcity. We had to secure and fight to get supplies. And as such, we ended the year with pretty high stock levels, in particular in a market like Vietnam. And then when the market turned to a decline in the first half, we had to navigate that. We had a very big destocking effect in the Vietnamese market. But towards the end of the second quarter, we saw our stock levels normalizing and our overall market performance in line with the market. For the first half, our market share in Vietnam is holding. That is very important. And we're actually growing market share in the mainstream segment, which is quite important, of course, during an economic downturn.
Dolf, one thing that caught my attention is that beer volumes in the Asia region fell by 13.2%, and sales of more expensive premium beers fell by even more. That, to me, tells you a lot about the state of the consumer, particularly because earlier on you told Tanvir that you're quite happy with sales in Europe, Americas, and Africa. To what extent are you seeing good demand to buy the more expensive beers, given that we've also spent a lot of the time here talking about the cost of living crisis?
Yeah, now particularly Vietnam is a bit an outlier, and historically we have been a mostly premium segment player in the Vietnamese market. So there we do see our premium brands like Tiger under pressure. If you look globally, but also in Asia and the APAC region, if you exclude Vietnam, our premium volumes are significantly outperforming the rest of the portfolio. As such, you can say people are maybe drinking less, but people are drinking better. We don't not only see it on brand Heineken, which is doing extremely well, also with the launch of Heineken Silver in the Americas region. Heineken Silver up 45% globally. And Heineken 0.0, now 5, 6, 7 years into the launch, still up. In the US, for example, mid-double digits, and globally in the mid-single digits. So, no, we actually do feel the portfolio resilient. We do see premium to be relatively strong compared to mainstream and economy segment, which indeed is very, very important.
A question perhaps that you were not expecting, but I do want to ask you a question about your marketing strategy and whether or not you've learned from the likes of your competitors, AB InBev, with their failed marketing strategy because they ended up getting caught in culture wars. Is this feedback that you yourselves have taken on board, and has it caused you to reevaluate how you think about your own marketing strategy in order to be more attractive to some of the younger, more aspirational consumers?
Yeah. Well, first of all, in the end of the day, it's all about brands. Our brands are, together with our employees, our most important assets. By the way, I will answer your question, but an important point to make is that even with all the challenges outgoing, we are ramping up our marketing and selling expenses very significantly by 0.2 billion in the first half of the year only. We do that to really make sure we invest in future growth, support our brands and innovations. To the spirit of your question, yes, particularly in the Western world, we do see a lot of polarization in society, and that's affecting all players, all actors in society, also businesses and also brands. And as such, you have to be thoughtful, you have to be balanced, and at the same time, you need to stand for your values and your principles. And we try to do that to the best of our abilities. And so far, I'm proud of how our brand teams across our operating companies are navigating this new world.
Right. What about resources costs, raw material costs, barley prices? What's your outlook thereof, especially given the weakness that you're seeing in the Asia-Pacific market and your presence in China? I wonder how much of China's delayed decision on barley trade tariffs coming out of Australia would have a bearing on pricing in the region.
Yeah. Well, in general, I think peak inflation on our input cost is now, slightly behind us. In the first half, our input costs were still rising in the mid-teens. We expect that to somewhat moderate in the second half of the year to the low teens. More progress will be made in 24. That's very important. We start seeing that in our hedge positions for the next year. We front-loaded our pricing. We said that in the release that was very deliberate, and as such, we do expect in the second half pricing also to moderate. And that's all driven by normalcy returning to supply. All those bottlenecks and scarcities that we've had are starting to dissipate. And very importantly, for a relative energy-intensive business, energy pricing moderating has been key to that. So in our outlook, we do expect that to continue heading in the right direction.